Hello scholars, what's happening everybody? Welcome back to my YouTube channel. My name is NM Lipsa and today I'll share with you on a very interesting topic, that is ratio analysis. Basically, today's topic of discussion will be classification of the key financial ratios. So what are the different financial ratios to analyze the company's financial statements? Before that, if you have not subscribed to my channel, please subscribe my channel and click on the bell icon for receiving my future videos. So let's dig in. Ratios are the financial indicator about the performance of companies. There are three types of primary users of financial information, that is the investors, lenders and creditor who provide resources. All those users, they need to understand the company's performance to make rational decision making about buying, selling, holding debt and equity or providing loans, because they expect net future cash inflows and they want to check that what are the resources available, whether management is efficient or not, and what are the claims against different resources. And in order to know that, they use financial ratios and judge the performance of the companies. And they do that by comparing the ratios with the different period of the same entity, or an entity's ratios may be compared with its competitors, even with the industry average. With this comparative analysis, they can identify a trend and make rational decision making. So ratios are very important, and therefore we need to understand what are the various classification of all the financial ratios to analyze the company's financial statements. Ratios can be classified under 5 categories: liquidity ratios, activity ratios, profitability ratios, coverage ratios, investors ratios. So today we are going to discuss all these ratios in detail in subsequent slides. So the first category is liquidity ratios. Liquidity ratios are the financial ratios which help in measuring the ability of the company to meet its short-term obligations, short-term debts. Liquidity ratios includes working capital, current ratio, which is actually the working capital ratio, quick ratio, which is also called as the acid test ratio, and cash ratio. The next category is activity ratios. So activity ratios are the financial ratios for evaluating efficiency of the companies. We can say that activity ratios helps in measuring how efficiently the management is using its assets of the companies. There are different types of financial ratios under activity ratios, such as accounts receivable turnover, days sales in accounts receivable, working capital turnover, inventory turnover ratio, days in inventory, accounts payable turnover, days of payable outstanding, cash conversion cycle, asset turnover. Let us now focus on profitability ratios. So profitability ratios are the financial ratios for evaluating the profitability of the company. That is, it measures whether an enterprise is successful or not in the given period of time. There are different types of financial ratios under profitability ratios. For example, profit margin, return on assets, which is also called as ROA, DuPont return on assets, return on total equity, return on sales, gross profit margin, operating cash flow. The next ratio category is coverage ratios. So these are the financial ratios for evaluating the long-term solvency position of the companies, focusing on the capital structure. Coverage ratios measures what is the company's ability to pay its financial obligations. Specifically, can they pay the creditors and investors who have provided resources to the company? There are various ratios under this classification. For example, debt to equity ratio, total debt ratio, total equity ratio, equity multiplier, times interest earned ratio. Last but not the least under the classification of financial ratios is investors ratios. Investor ratios are the financial ratios for evaluating stock as an investment. Basically, investor ratios are used to measure the ability of business to earn adequate return for the owners of the business, because they have put their money into the business and they need return. That, is compared with the risk involved in any kind of projects or any kind of assets. So they are very curious to measure the performance of the companies, and some of the common ratios which are used by the investors are earning per share, price earning ratio, dividends per share, dividend payout, and dividend yield. Thank you very much for taking time to watch this video. I really hope you guys enjoyed the content of this video and found it useful. If you got any value from this video, please share it with your friends or colleagues who may also benefit from it. And if you enjoyed this video, you may want to check out some of my other videos. Do not forget to like, share, comment, subscribe to my YouTube channel. Thanks again for joining with me today, and I hope to see you around here again. Have a great day.